Hey everyone, welcome back to another episode of the Laundromat Millionaire Show with Dave and Carlo Menz, sponsored by HM Company DrainTroughs.com. We have an exciting episode for you today. When I say exciting, you may not get super excited about the topic, but it's really, really important. And basically what we're going to do is today we're going to talk about the 4 different types of debt that we've used to be successful in business. And we're going to talk a little bit about kind of consumer debt versus business debt, although that's not a big part of it. But we're going to talk about the different financing that's out there for you. So whether you're a newbie or you're looking to consolidate, if you currently have a chain of laundromats, maybe you'll grab some information out of this that'll help you out a little bit.
But before we get into that, we'd like to have a spotlight for you today, and that is our Black Friday sale. Currently, through December 20th, we are having our first ever sale event on the Laundromat Millionaire website, including offers such as $500 off of our coaching programs, $750 to $1,000 off of our workshops, and we currently have up both March and May that you can get that off of. Let's see, $500 off of our wash, dry, fold, and delivery blueprint, our handbook for pickup and delivery and wash, dry, fold, and also $250 off of our new owner's course, our online course. So a lot of great deals. Be sure if you are interested in any of those products or services, be sure to get on our website and check them out before December 20th, before those sales go away. So that's a little bit about our Black Friday sales event. Also, Laundry Boost is having a Black Friday sales event still going on. Now, I believe that one only goes through the end of this week. So get that before December 14th. But up to $2,500 in savings through Laundry Boost for your marketing. So definitely check those out. But let's go ahead and get on with today's episode.
And I'm telling you, it's one of the most powerful things in the world.
When you're taking out a loan, look at what are you getting with that money? Is that money going to generate more money for you?
And that's literally a microcosm of how we've went from a net worth of $50,000 to multimillionaires via the laundromat industry today.
All right, so today is all about debt, the good, the bad, the ugly. So we've all been there, and we can definitely speak from experience. Unless you have buckets of money coming into the laundromat industry, you are going to have to take out some loans. It is a capital-intensive business, and not everybody can afford to just buy their equipment and their business outright, as we couldn't in the beginning as well. So today we're going to be talking about good debt versus bad debt, how to use debt to benefit your business. And then we're going to dive into the 4 different types of debt that we've had experience with and the pros and cons of each. And hopefully you'll leave here with a little more knowledge about whether you should take out that loan and who to go to.
Yeah, and maybe you'll just learn about some different loan programs or types of loans that you didn't even know existed. That'll just give you some flexibility and some options. Before we go into the 4 types of business debt, and that's kind of the premise for the entire podcast today, is this is around business debt. Mm-hmm. We want to just talk a little bit about debt in general, personal finance, consumer debt. Like Carlos said, kind of good debt, bad debt conversation. And we're not going to go super deep on this, but we want people to know that, at one point before we got in the business for ourselves, we were very conservative. We had no debt except for the debt on our home. We had a good savings account and, no credit cards, no auto loans, no anything like that. And if you're in a personal finance world, that's a pretty good thing to do, right? That's a pretty good idea in general. You don't need our approval for that, but it's kind of the Dave Ramsey type of approach. But when you get into business for yourself, you learn that there's a whole different side of the world out there, especially when you're in a capital intensive business like the laundromat industry, where, in our situation, debt just wasn't an option. We wouldn't be where we are today if we hadn't learned how to use and leverage debt responsibly. And so we're going to share some of those kind of, caveats with you today, some of the things that we've learned along the way. So one of the things I want you to understand before we even get into this today is that debt is a tool, right? And you can use that tool for good and you can use that tool for bad, right? I always talk about with the internet. When the internet came out, we all thought it would be this amazing, wonderful thing. And in some ways it has been. It's connected the world and gave us access to all this information. But we all know there's a dark side to the internet, and it has been used for evil as well. So just remember that all debt isn't good. all debt isn't bad. There are some people that kind of take that and run with it to the extreme, and they tend to be kind of the Dave Ramsey of the world on one side and the Robert Kiyosaki's on the other side. And I follow both of them. I love both of their content, and I am grateful for both of them. But the truth is, I think the happy medium is probably somewhere in the middle. But if you dig down on both of their information and their content and their teachings, you'll find that they even agree that there are caveats and things like that out there. But one of the things I want you to just understand is that, a lot of people get crushed by debt. And I'm once again talking about consumer debt here, auto loans, credit cards, payday loans, high interest type of loans, where they use it to buy, we call it junk or stuff. And it could be a practical stuff like a car or a purse or a TV or something like that, but it's all consumer things. They're all things we purchase to consume, to use, right? Versus what we call good debt, what Robert Kiyosaki refers to as good debt, which is ultimately as simple as debt used as an investment tool to increase your cash flow or increase your net worth. Right? That is good debt. And can you have too much good debt? Yeah, you can. It's called being over leveraged, right? And you can get yourself in big trouble if you get too much good debt too quickly where the cash flow doesn't catch up. So we want to just throw out all those caveats before we even get started today, we don't want to mislead anyone. And we always say we pretend like we're speaking to the person with the least amount of information. So like we always want to talk to the newbies and the young people that are, just got married or maybe are still in school or something like that. And maybe we oftentimes in these podcasts, we feel like we kind of take for granted what you know or what you don't know, or, full transparency. Before I met Carla 25, 30 years ago, I was married for a short period of time, made some very bad decisions with consumer debt. And when we got divorced, I had to file for bankruptcy. The truth is, transparently, that was a very difficult time in my life. But looking back on it now at age 48, I'm actually grateful for it because I learned a ton. I learned a ton of things that I didn't learn growing up that I didn't know about personal finance. Carla's story is a little bit different with the way she grew up. And so we've melded those things together and been able to build a nice life for ourselves. But ultimately, we just want you to know that, at least in our opinions, we're kind of split the difference sort of people. We're kind of in the middle of, personal debt for auto loans and car loans and credit cards and things like that are, generally speaking, not a good idea. Once again, we're not here to tell you how to run your life, personal finance, or business. We're just here to share our stories, but we want to put this kind of caveat out there in the beginning just so you understand kind of where we're coming from, how we look at things, and if you look at them a little bit different, we're okay with that.
Yeah, talking about good debt versus bad debt. So Dave's more the entrepreneurial spirit, where I definitely was raised that debt is bad. Like, other than a mortgage on your house, you should not have debt. Like, my parents always had their cars paid off, credit cards. It was fine to have a credit card, but you had to pay it off every month. You never kept a balance on anything. So there's definitely been a transformation in my understanding and my comfort with any debt. So for me, I have to kind of simplify things down. For me, good debt versus bad debt. Good debt is, will it create more revenue? Like, me taking on this debt, will it create more revenue than, I like to think, than even of that debt payment? Will I be bringing in more money than the payment on that debt? Basically, will it be able to pay for itself? Where bad debt is money that just goes and it's gone. So good debt, if I'm investing in a business that's going to bring in more money than that debt, that's a good debt. Bad debt, if I'm, taking out a loan for a vacation. Yes, I'll have memories after that, but it's not going to generate any revenue. That money's just gone. And Dave mentioned, sometimes even personal debt can be a good debt. Taking away from the business owner, maybe if you have to take out a debt for a car, but that car is going to allow you to go to your job where you're going to be generating income, maybe that's even a good debt if necessary. But simplifying it for me, good debt versus bad debt is, when you're taking out a loan, look at what are you getting with that money? Is that money going to generate more money for you? So that's how I simplify it in my mind.
Yeah, very well put, Carla.
We'd like to talk about a product we use in our laundromats that really helps elevate the customer experience. Magazine Jukebox. Magazine Jukebox provides digital entertainment for your customers while they're at your laundromat. It's so simple to set up. You place signage around your location, visitors scan the QR code on the signage, and then they enjoy magazines, games, and trivia on their own mobile devices. This keeps your customers entertained, engaged, and happy while they're waiting for their laundry, creating a more positive experience for your laundromat. The platform also offers internal advertising banners, helping with retention and that return on investment. Sign up for Magazine Jukebox on our website at laundromatmillionaire.com/services.
And then the last point I'll throw in there, just so we all understand, is when it comes to business and things like that, there's also risk. Right? So we have to factor risk in too. And a lot of the risk is, how well do you know the industry? How much experience do you have? Do you really understand the opportunity? If you're a newbie, you may think you're seeing this opportunity very clearly, but your lack of information, lack of education, lack of experience, there may be 3 things over here that you don't see. Right? And so the risk is high, but the risk is higher than you actually think it is because you don't know your industry. That's where a lot of people in the business world that you hear, like 50% of all businesses fail within the first 5 years. Those statistics are true. A big part of why they're true isn't so much about the debt and the leverage, it's about the knowledge, the education, right?
Get a good mentor.
Right. So that's why, not to promote that too much, but, that's why we do coaching. It's why we do workshops. It's why we do podcasts like this to try to help the industry as a whole. It's why we speak at conferences, put on our own conferences, attend conferences, is just to connect and build relationships and share and network with each other. So that's a big part of it too, is, the math is the math. I always say, I love data. Data is a very valuable thing, but there's always exceptions to the data. It's only as good as they always say, garbage in, garbage out. The data is only as good as what you're putting in. And if you're only putting in 8 out of 10 factors because 2 factors are from ignorance that you don't know and don't understand, then your risk is a lot higher than you think it is. So that's where you can get in trouble with debt and being over leveraged when you think a business opportunity is better than it is. Because, let's be honest, all of us, even people that are really experienced, we still make mistakes. So that's all part of the situation. But before we dug into the 4 types of debt, we really wanted to just kind of have that kind of caveat out there for you to understand where we're coming at it, what our backgrounds are in, and be real transparent about, what we've experienced in our personal lives. Okay.
All right. So the 4 types of debt. So our first one we're going to talk about was our first business debt, which is through the SBA, if you've heard of that before, the Small Business Administration. So when we went for our very first laundromat, unfortunately, we got turned down by a lot of banks out there that we had no business experience. We had saved up about $30,000. So we did have a little bit of money. We were both working full time, so we had a good amount of income, but no business experience. And the local banks were not interested. But we were able, through one of our local banks, to get a loan by having it backed by the SBA. Dave, you want to talk a little bit more about the SBA loans?
Yeah, so there are many different programs that they have, but the 2 most common ones, especially for us small business owners in the laundromat world, is the 7A, which is like a $500,000 up to about $5 million of what you're borrowing, and then they have what's called the SBA Express, which is 0 up to $500,000. Those are the 2 most common for small business owners. There are other ones that include commercial property and things like that, but these are just for buying or starting a business. One of the things I always like to tell people is keep in mind with the SBA that you're not dealing with a bank. Right, traditionally. And what I mean by that is a lot of people don't know this, but the SBA is the only government program that was ever created by the government that's self-sufficient. So us taxpayers have not funded the SBA. A lot of people think we do, but we don't. If you research the SBA, it's a self-funded program because they charge you fees. So the way the SBA works is they don't actually write loans. They act as kind of a cosigner. So they back a loan through a traditional lender. The lender actually makes the loan, but they might not and usually would not have made the loan or written the loan without the SBA's backing. So it's almost like having the SBA as your mom and dad, and they're co-signing the loan for you. And they know that the SBA is good for it, right? And the way the SBA covers those bad loans is through fees. So when they do an SBA loan and they approve it, they charge you a small fee. They put all those fees into a coffer because they're a nonprofit. And when occasionally loans do go bad, because they have a vetting process and everything like that for these loans, they don't approve them all. And the ones they do approve, they think are going to go through. And when they don't go through, they have to make those banks whole. And basically what they do is they minimize the risk. So if a traditional lender might want you to put 30, 40, 50% down, and you can't let's say you can only put 10% down, the SBA might back that loan and they'll guarantee it up to 80, 90%, depending on the loan and the amount and things like that. So that's they're minimizing the risk from 60% to 90%. They're allowing you to put less money down, and they're basically guaranteeing it. And they're guaranteeing it with funds from all the other fees that they wrote that us business owners paid them $500, $1,000 to write that loan, and that loan never went bad. And so they took that loan and they didn't need that $1,000. So they just set it in the account over here, and they use that to make the bad loans good. So a lot of people don't know about the SBA. So what are some of the bad things about an SBA loan? Well, there aren't a ton, to be honest, but the ones that are there are very real. First of all, they're a gigantic pain in the butt.
There's a lot of red tape and a lot of paperwork being requested multiple times, even though you already gave it to them 3 times.
Terrible communication for the most part. And for us, to tell you our story real quick, when we bought our first loan, or bought our first business, we were buying a laundromat that was a zombie mat. It was losing money. It was negative cash flow every month, but it was in a good location. We knew it would be a great opportunity because of the laws of supply and demand. There weren't really any decent laundromats around there. And we knew with a little bit of TLC and some education that we could turn it, or we felt like we could turn it around. But the business, we were paying $85,000 for it, pretty much for the location and the equipment that was there. And the SBA is looking at it through the lens of it's just losing money. Well, all the lenders were. And so they're thinking, you never owned a business. Why would you buy this business for $85,000? Well, we ended up buying it. We financed $70,000 through the SBA. We had to pay them, I think, a couple $1,000 fee for that. And fast forward, they approved the loan for us at reasonable terms. We paid it off in, I think, 4 or 5 years. And they got to keep that fee and take it to use and guarantee somebody else's SBA loan. But the reason we like to put it out there is it is kind of a logistical pain in the butt. They're pretty bad at communication. They're not very well organized, like most of the government things are. Not very well run for the most part. Not that the people aren't good people, but it's just, anytime you're dealing with the government, you kind of get what you get. But the program works phenomenally. In fact, it's probably one of the best run programs the government has. So we're big fans.
Yeah, and the terms are good. Their terms are very good.
Yep.
Yeah, the rates are usually pretty good. And a lot of times you can get approved through them, even though it's a long process. You can get approved through them when you can't get approved through those regular lenders. When Dave went to various lenders, kept getting no, but our local credit union, when he went to that lender, they said no, but they said, we do have this SBA program. You could try through them and we could see if that works. So definitely for newbies who don't have much business experience, you're going to have a lot of trouble getting loans through the conventional lenders. So I highly recommend the SBA as an option to get that loan and get a loan with some good rates as well. And putting less down. So definitely if you don't have much money to put down in your business, or if you have a decent amount but would like to use that more to improve the business and not have to put it down on that loan, then I would definitely recommend the SBA.
Yeah. To share with you real quickly, I mean, we were turned down over 20 times to buy that first business. And if we hadn't been told by our credit union about this SBA program, and in case you're wondering, they don't put you on an island. They walk you through, the lender walks you through the process with the SBA. They typically will have an SBA expert in their company that will help them walk through the process and, back and forth, and they act as kind of a middleman. And then when you do end up closing, the SBA sends the closing paperwork to the lender, and then you meet with the lender just like you normally would. You just kind of have this third party back here co-signing the loan for you.
Whether you already have a laundromat or are looking to get into the laundry industry, everyone needs proper drainage. We use HM Company drain troughs. Their drain troughs were first created in 1991, and they have been the leading drain trough manufacturer ever since. They're made in the USA, and their drain troughs are fully customizable to meet your needs. That's why we've used them ever since entering the industry. They're easy to clean for our staff and plenty sturdy when we need to walk on them when servicing our washers. With the ability to span up to 25 feet, our troughs rarely need to be connected together, creating an easy installation. Want to slope your trough like we do? No problem. Just let the experts at HM Company know. For more information, go to their website at draintroughs.com. That is draintroughs.com. HM Company Drain Troughs. They've been leading the industry since 1991. Check them out today.
So, all right. So number 2 is conventional loans. And we're not going to spend a ton of time on this because it's pretty straightforward what a conventional loan is. But you're dealing directly with a bank. In the case of a business acquisition or a new construction business or something like that, they're usually going to want 30, 40, sometimes even 50 or 60% down. So they're not going to want to take a lot of risk here. They are going to a lot of times require additional collateral, personal guarantees, things like that. We have used conventional loans to buy commercial vehicles, business lines of credits, refinance commercial properties, things like that. So there is a place and a time for them, but there's also kind of a negative side to them of keep in mind that this isn't typically what these banks do every day. They're not in the business of making business loans. So a lot of times they don't understand our business. And in fact, most of the time they don't understand our business. And because they don't understand it, they're very scared, they're very apprehensive, and they can't kind of act as a mentor to you where other type of loans can.
Yeah. Some of our experience too with conventional lending is we found that they're pretty useful if you are buying the property. So if you're buying a building, a lot of times they're more comfortable doing the mortgage type loans, even for a commercial property. Again, the vehicle loans, but they're a little harder to do any type of buying the business where you're just going to be leasing it. You're not buying the commercial property or even buying equipment. And I think part of that is one, not understanding the business. Because remember, if you aren't able to pay that loan, then what happens is they seize your property, right? Well, they do not want a laundromat or they do not want laundromat equipment that they then have to figure out how to sell, how to get value out of. They're a little more comfortable with the commercial property because they've sold property. They sell houses and stuff like that if they foreclose on things. They have kind of a line to go with that. Also, lines of credit. Sometimes they're willing to do a business line of credit. That's nice for a little extra cushion, depending on your cash flow, or if you're wanting to do some projects where then you can pay it back more slowly if you have like a big chunk of investment. But yeah, for those equipment loans or even overall business, especially if you're new to that business, the conventional way does not tend to be very successful.
Yeah, I mean, just remember that it is what it is. It's like a conventional in the truest sense of the word, mediocre, very average, right? They want to minimize their risk, but they really know nothing about your business. They really know nothing about the collateral and how to do anything with it. So if that's the case, how are they, the lender, going to react to this loan? Well, even if in every way, shape, and form, the loan and you as a lendee seems to be no risk at all. You know, you're worth thousands of dollars or millions of dollars and your credit's great and you own other businesses, you've been in the industry for 20, all things aside, they still have to look at it through the lens of their risk, which is if this goes bad, I got to take the business back. And like Carla said, they don't know what to do with it, right? Mm-hmm. And not only do they not know what to do with it, but it would be very cumbersome for them. If they repossess a home or a commercial building or an auto loan, or an auto car, a car or something, they know how to liquidate that, right? There's a process for that. You call a realtor and you get comps or send the car off to auction and they get what they get and they write off the difference. With a business, not only do they not know what to do with it, they really don't know how to even value it. Sometimes they think they do. They value it based on net operating income and things like that, but they don't know anything about the equipment. So, okay, you have 5-year-old washers and dryers. Is that old? Is that new? You have to put yourself in their shoes. They know nothing about this. So they're very, 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 very conservative in their terms. You're typically going to have a little bit higher rate, and they're going to, it's worst case scenario. That's why I say, I know it sounds insane, but I mean, they're going to want 30, 40, 50, 60% down. They're looking at it like they're basically really telling us business owners, we really don't want to write this loan. But we won't tell you no, but if you put 60% down and we charge you 12%, we'll do it. And they know that you probably have better opportunities than that. So you're probably not going to do the loan. And there are exceptions to that. There are credit unions and small business or credit unions and community banks and things like that kind of have a a business department, if you will, and they kind of specialize in that. And they have some people that work there that do this all the time. And a lot of times they'll have loan officers that have business experience, and they'll know a little bit more about it, and you'll be a lot more likely to get a loan approved through them. But for the most part, conventional business loans in the laundromat world are generally speaking not a great idea, but hey, always take a look.
I don't even know if I'd say they're not a great idea as much as they're difficult to get.
Yeah.
And one other thing you kind of mentioned was with valuing your business. An obstacle we've found is typically for those conventional loans, they want to look at your previous year's tax returns, which is no big deal, except if they're not familiar with the laundromat industry and how capital intensive we are. They're not familiar with the amount of depreciation and amortization that we are deducting from those from our income tax statements. So a lot of times our income looks quite low, but it's not because we truly did not have much income, but it's because of the amount of deductions we're able to take on our tax returns for things like the depreciation of all that equipment you bought and everything like that. So we found a lot of times the traditional lenders, we found that a lot of times they did not feel comfortable with the amount of income we have on our income tax statements. And so therefore they did not want to lend to us as well.
Yeah, that's a great point, Carla. And just take it a step further in case you're not following us. This isn't about you not claiming taxes, right? You're not
we're claiming all of our revenue. It's just the deductions.
What it simply is these some, not all, some conventional lenders, traditional lenders, are typically used to looking at a W-2. Right, and a tax return, and you made $80,000, and they took out this much in payroll taxes, and you were taxed on $72,000 or whatever the number is, right? Well, when you look at a business, it may generate $3 million in revenue, have $780,000 in profit, and have $60,000 in taxable income. Well, it doesn't mean you didn't make the $700,000 in profit. You did. It just means it's not taxable income. Right. And I'm sure most of you business owners, you know what I'm talking about. But the truth is, when you get into the traditional commercial lending world, it's amazing how many people don't understand this. Even the executives, the VPs and stuff, they might have just moved over from residential mortgages last month, and they have no idea what they're looking at on your tax return.
Well, even in the business departments, this is, I think, magnified in the laundromat space because we are so capital intensive. I mean, if you're looking at another entrepreneur's tax return, but he's a doctor, I mean, he doesn't have a lot of equipment that he's depreciating and stuff like that. So it's even more so, I think, amplified in our industry. So even if they have business experience looking at business income tax returns, sometimes I think the laundry industry tax returns are even more surprising to them.
For sure. And I have some friends, this isn't a secret, I talk about it all the time, but I have some friends in the restaurant industry. Restaurant industry is also known for being pretty capital intensive. And I have a friend that's very, very wealthy and very invested in the restaurant world, different franchises and things like that. And he was joking with me one day that his tax return requires 16 accountants and an abacus to figure out. And he was telling me about how he tried to get a fairly modest for his net worth mortgage on a home, and he couldn't get any lender to agree to it. And he could afford to write the check and pay cash for it. But the terms at the time were like 2% for a 30-year mortgage or something. So he wasn't going to write the check. He was going to borrow the money. And he had to go through his accountant, who went through a specialist of his and found a conventional mortgage company that would do residential mortgages, and they specialize in doing them for entrepreneurs. And as soon as they pulled up his tax return, they knew exactly what they were looking at. They understood how to read it. And honestly, none of this is really that complicated. It's just keep in mind, we don't live in a world of entrepreneurs, right? Us entrepreneurs, we're weird. We're different. We're about 3%. 3% of the population in the U.S., which means 97% of people work a W-2 job, right? So they're just not used to dealing with us. And especially when they start to see multiple 7 and 8 figures and things like that, right? They just get really scared and intimidated. So once again, not that we're smarter than them. This is just the world we live in, and this isn't the world they live in. So when you look at it through the lens of a conventional lender, or really any of these types of lenders, I always say, put yourself in their shoes and deal with it in that scenario. And a conventional loan just a lot of times is not worth the hassle because you can't convince them of things that they just don't believe are true.
Would you like to make more money from your laundromat? Would you like those machines you're paying for to have more turns per day? Do you offer wash, dry, fold services or pick up and delivery laundry services? If not, would you like to? Whether you do or not, we have an amazing opportunity for you in Cincinnati, Ohio.
Yeah, you've probably heard about it, guys, but it's our wash, dry, fold, pick up and delivery workshop. And to answer your first question, yes, it is for drop-off laundry, wash, dry, fold, and pick up and delivery. So if you're doing any of those things, this workshop is going to help you tremendously. But the truth is, we were pretty so-so laundromat owners and so-so successful until we launched drop-off laundry and pick up and delivery. And being able to what I call optimize your laundromat to generate more profit and more revenue out of the existing facility, that's the key to taking your life from good to great, financially speaking, with laundromats. And that's what made us Laundromat millionaires.
You don't have to just listen to us. Listen to what some of our past attendees have to say about our Wash, Dry, Fold, Pick Up and Delivery workshop in Cincinnati, Ohio.
It was the best workshop I've attended in over 25 years. And what you guys have put together is nothing short of phenomenal. I think that you guys have put together both strategic and tactical systems that will make an individual who wants to own the laundromat profitable within months, not years.
Was the workshop worth the investment? Without a doubt, it was definitely worth the investment. So not only did we have two very packed days with Dave and Carla and their team, both in the classroom and touring the facilities, but we also came away with this extensive 100-page handbook. And then after the workshop was completed, I received a bunch of electronic performers and templates that we've been able to use since the workshop. Every day since the workshop, I've found myself referring back to either those electronic tools or the handbook that we received. So,
was it worth the investment? Absolutely, absolutely, absolutely. I cannot say that enough. This was such a blessing, and I am so very grateful that Dave and Carla put this together and are sharing their knowledge and experience with others to have this to grow their business and to become more successful. Thank you, guys.
So are you interested? Go to laundromatmillionaire.com to learn more and see where you can register.
So the next one is equipment loans. And I know a lot of you out there probably have a lot of experience in this because of the laundromat industry, but equipment loans are a big part of our industry because we are so capital intensive. And, you know, there's the Eastern Fundings and the Prime Capitals and the Firestones of the world, which kind of specialize in the laundromat industry and doing equipment loans for our industry. A lot of times they'll specialize in one or two other industries, but they're what we call third-party independent. So they don't represent a manufacturer. They'll finance an acquisition, they'll finance a franchise, they'll finance a new build or a retooling. They'll do a $50,000 equipment package for a little laundromat like we were 30 or 15 years ago, or they'll do a $2 million project and anything in between. And then there's what I call manufacturer-specific financing companies, which is, Alliance and Dexter and Laundrolux and all these companies, Maytag. All the manufacturers have their own financing arms, and they, for the most part, pretty much just finance their equipment, right? Mm-hmm. So that arm is there. It's a profitable entity. It's a separate sister entity, but it's pretty much there because they know there isn't enough business out there for all of us laundromat owners to just write $700,000 checks to buy a package of new equipment. And the good thing about these types of loans is the terms are actually pretty good. Now, the interest rates tend to be a little higher, but the terms tend to be good. And what I mean by that is a lot of people don't know this. When you do an equipment loan through like a manufacturer, most of them will give you like at least 90 days, if not 6 months, of no payments at all. And in addition to that, a lot of them will give you 9, 12 months, 18 months interest only before you have to start paying principal. And a lot of times, instead of it being a 5-year loan, it'll be an 8-year loan, or instead of a 7, it'll be a 10. And the reason for this really makes a lot of sense if you kind of get into their brains, and a lot of these people are my friends. So when you look at it through their lens, they understand that if you retool an old laundromat and you put in $300,000 in new equipment, they know for the most part that equipment is going to pay for itself. But they also know it probably isn't going to cash flow itself in month 1. right? And so they know they need to give you a little bit of runway, right? That helps you build up some cash because we all know, well, most of us know, when you put new equipment in, you're going to get a significant bump in income and revenue, and you can raise your prices, and you're going to drive new customers into your store. They know all that. We as owners know all that, and so they can bank on that, right? That's part of their data set, is they know that's going to happen. How do they know that's going to happen? Well, because this is what they do, right? They do it every day. They do it in this industry.
I think that's one of the biggest bonuses of going with the equipment loans, or what I like to call the industry-specific financing, is that they know our business. And so a lot of times they're a lot easier to get because they know what they're looking at. I mean, they know what that income statement means. They know what that tax return means. They know when they're looking at the layout of the store that you're buying and the equipment that's currently in that, they can value that accurately. And they know the impact of the changes you're making. So they know the business, but a lot of times that also means, in addition to being easier to get that loan, is a lot of times with it comes a bit of a mentor, because they want you to be successful. It's almost like having a partner without having to share your profits with them, though I guess you kind of do through the form of payments.
You have interest.
Yes. But it's like getting a partner because they're invested in your business because they want to make sure you're able to make those payments back to them. So, when they're looking at everything you have and they see, ooh, this layout could be improved by, and, they have years of experience under their belt. And we have used equipment loans. I mean, we've gone through Eastern Funding, we've gone through Prime Capital, we've gone through Alliance because we use Hipsch equipment, and we've used them. Another big bonus is a lot of times they are willing to not just be an equipment loan, but they will add other things into the loan. So maybe, in additional to your equipment package that you're getting through them is you want to get that SaniWash ozone system. A lot of times they'll loan you the money for that, or for maybe some of the furniture around your laundromat that you want to add, or a new floor you want to put in, or maybe that Hydro Perfect pour. I don't know. But you a lot of times can roll other things into the loan, as long as it's all going into your laundromat to make it an overall better business.
Yeah, and usually they say that's just complementary things. So like they're not going to lend you something that's nothing to do with your business, right? But if it's complementary but not manufacturer specific, like I know, like, and don't keep me on the percentages, but like Alliance and Dexter and the companies that a lot of times they'll do 100% financing on up to, this is arbitrary numbers, right? A couple $100,000 of equipment. And then you're like, oh, but I also want to put an ozone system in, and that's $40,000. And I'd be like, okay, we'll do that too. Okay, well, I want to do $10,000 in folding tables. I'll be like, well, we can't do that. We can, we get into the other ancillary things. They'll do a little bit. I've heard numbers like 10, 15, 20%. So if you borrow $100,000, they might do 10, 15,000, 20,000 of ancillary things, or build out or things like that. But they're not going to go crazy with them because their main job the specific to the manufacturers, their main job is to support that manufacturer selling equipment, where the independent third parties like the Eastern Fundings, that's not their job. Their job is just to make money and to help you grow your business. A couple of things I'll throw out there real quickly with the equipment loans and the third party lenders specifically, and even the manufacturers, is a couple of things that's really beneficial to them knowing this industry well is red flags will jump out at them. Right? That will jump out at them because the people writing the loans and underwriting and even the loan officers, this is typically all they do. So they see this all day, every day. And these same people, these loan officers and even the founders of the companies, friends of mine and things, they're at the conferences. Sometimes they're speakers at the conferences, or they're networking with us at happy hour. And so what do? We all us laundry nerds talk shop, right? And they see loans all day, and they talk to loan officers all day, and they talk to laundromat owners all day. So you do that for 20 years, and even though you've never technically owned a laundromat, you know a lot of the common red flags. And so when you come to them with an acquisition or a retool, you're like, hey, I want to do this and this. As she said, they can act as kind of a mentor and be like, hey, I'm noticing this is jumping out at me, like 45% utilities as a percentage of sales. Like something's really wrong here. Oh, it's 30-year-old equipment. That makes perfect sense. Well, guess what? We know that's going to drop down to 10 or 12% when you put new equipment in. And they can factor that into their data analysis because they do this every day. Last thing I'll throw out there, and I won't say who it is, but this has happened to us twice. Twice I have had loans written for us that mathematically and data-wise should not have been approved. And the lender told us this. It was two different lenders, two different situations. Both times they told us, Dave, based on the math, I should not lend you this money. but I know you. I've known you for 12 years. You're one of the top laundromat operators in this industry. I know your vision. I understand how you grow. I've been in your stores. I've seen how your team treats your customers, and I'm betting on you. And so there's a 10% variance of, I should decline this, but I'm going to give you an extra 10% bump, and I'm going to approve this on no other thing than you are one of the top operators in this industry, and I know you as a human being, and I've met your team, and I know your vision of where you're going. I know where you started, and I'm betting on you. I'm betting on the horse or the jockey, right? And so that has happened. But the thing you want to be careful with in that situation is if they're doing it when they really otherwise shouldn't data-wise, that might cause you to kind of take a deep breath and say, man, maybe I'm getting a little over leveraged here, right? Because that's the other side of debt that, we won't spend a ton of time on today, is just there's such a thing as healthy leverage. And then there's a middle ground of, okay, we're getting in some, there's some gray area that you can push the envelope. And then there's, okay, this is a little bit unhealthy. And you want to be careful with that too. So just because they will approve it based on your reputation, that might want to cause you to personally take a deep breath, look at the project again through a different lens and say, can I maybe cut this down by 10, 20%? Can I maybe do this? Should I maybe wait another year? Should I put another $100,000 down? So that's the other side of it, is just because you can get more leverage based on your name and reputation, you want to be careful not to do that too much, because that'll bite you too. Okay. A couple things I wanted to throw out there real quickly. I don't know if this will help you at all, but I just jotted down a couple things real quickly when it came to equipment loans that I thought I would share with you. So in 2010, when we bought our first laundromat, about 6 months in, we realized that the old equipment was in such bad shape that we just couldn't keep putting Band-Aids on it. It wasn't going to stay in service, and our store kept growing. We kept getting busier and busier with more and more customers. And so I went to my distributor. I said, I don't know what to do about this, but I was new to the industry. He said, well, you need some new equipment. That new equipment will take the wear and tear off of your older stuff. Everybody will use the new stuff first, and it'll just run all day, every day. Okay, awesome. So in 2010, we borrowed our first equipment loan through Alliance for $85,000, and we bought a few. I think it was 6 or 8 washers and maybe 3 or 4 dryer packets or stack dryers. And it wasn't enough to retool the whole store, but it was what I call a stair-stepped approach. It was just enough to get going, and that equipment paid for itself by the time our first equipment payment came due 90 days later, and we were able to actually pay that off early. So it not only paid for itself, it actually gave a huge shot in the arm to our business. We were terrified because we had just borrowed $70,000. We didn't know how we were going to pay back. Then we turned around 6 months later and borrowed another $85,000, which to us was like $10 million. Back then. But that was the first equipment loan we did. We did one not too long later, less than a year later in 2011, borrowed $250,000 when we acquired a second store. And we did a total retool on that store. And that was profitable within 3 weeks of opening it. It was actually closed to the public. We took over, signed a lease, spent a couple months gutting it and retooling it, a lot of sweat equity, put some money on our credit cards, things like that, borrowed a $250,000 loan, painted all the dryers, sanded them down, made them work a lot better and look a lot better than they did before, and put all new washers in the store. And that was a very profitable equipment loan that we took out. In 2014, when we bought one of our stores, we borrowed $300,000 for probably a 60% retool of that store. And that was profitable for us within about 6 months as well. And then again, these are not the only ones we've done. These are just a few examples. In 2015, when we bought our fourth store, we had pretty good cash flow at that point from our first 3 stores, and we borrowed $450,000 and did a total retool. Did like $100,000 improvements in the actual facility itself, tearing down walls and remodeling the bathroom and things like that. And then we put a bunch of new equipment in there as well, raised prices, things like that, and we were profitable almost immediately. So those are all
new equipment pays for itself is the message.
A general rule. I mean, I don't want to always say that's true.
Yes, for us it has.
Yeah,
it has consistently.
I always joke with my distributor and even my lending friends and things like that. I'm like, I've never borrowed $1 and I've never bought a piece of equipment from you that hasn't paid for itself plus some. And that's what made us multimillionaires. So the reason I bring that up is equipment loans can be a great way to give your business a shot in the arm. You can do it in one huge package if you can get the financing, but there's more risk there. Or you can do it in what I call a stair-stepped approach, and you can do 3 or 4 smaller loans. I always say borrow $100,000, give that injection into your store, let it marinate for 6 months or a year, get the cash flow up, use that cash flow to justify another $150,000. And that's literally a microcosm of how we've went from a net worth of $50,000 to multimillionaires via the laundromat industry today. So the equipment loans are the third type. And then the last one is my favorite.
Dave loves this one.
My favorite.
So the last one, number 4, is seller financing.
This is where the magic happens, folks.
Yes, and this is Dave's favorite, but I will say, I think you need to be a good negotiator, which is why Dave likes it, because he's good at talking and definitely talking, but good at negotiating with people and figuring out kind of some win-win terms. I would be horrible at getting seller financing because I'm horrible at negotiating. But luckily, if you aren't a good negotiator, get a good negotiator to help you with the seller financing. But Dave, you want to talk a little bit about this one?
Well, I think the first thing I want to point out to people is the thing I love about this the most is with the right person, because this isn't a conventional loans. This isn't a alliance manufacturing arm financing. This isn't, SBA government program. This is just 2 human beings. Mm-hmm. And if those 2 human beings can come together to a deal that makes sense to both of them, where they both win, I always say the reason I'm good at this isn't because I'm a good talker. It's because I genuinely go into the deal and be like, well, I know what I need to make this work, and I'm genuinely interested in what will help you win. Help me, teach me, talk to me, tell me what will help you win, and I genuinely care, and I will kill myself to make sure that you win too. And that's the key to negotiation. If you read like The Art of the Deal and some of these other, experts on negotiation and things like that out there, that's one of the things that most of them will agree to. And the thing I love about this is there are no rules, right? So when you do seller financing, the whole world is available to you. If you want to finance for 30 years at 2%, and it makes all the sense in the world to the person that has this piece of commercial property paid off, I just think it's a beautiful part of business, and I love everything about it. But the thing I want to point out to you, other than a few little caveats, is the whole world is available to you. But here's the key to the whole thing. You got to put yourself in their shoes, and you got to truly look for their win, right? And part of that is sometimes just convincing them that you actually are doing that. Because you can tell them that you're doing that, but if they don't actually believe you, they think you're full of crap, or you sound like a really good salesperson, then you're not going to get anywhere. You have to genuinely build a relationship with them and have lunch with them and ask about their family. And
you have to actually listen to them and learn what they value, learn what they're going to be looking for in the deal, but just not in the deal. What do they value?
Yep. One of the things I also really love about this that is not wildly talked about, if I'm honest, but I'm going to go down this rabbit hole for a second, is laundromats aren't as easy to sell as people think they are, right? Selling a laundromat is a tricky thing because it is a capital intensive business. So there's a lot of infrastructure that you're purchasing, but the value of it and how many turns it has and the life cycle, a lot of that's based on the usage of it, and not just the years, but how much it's been used each year. And so that can be a very tricky thing to calculate. A lot of small businesses are just sold based on a multiple of net operating income. And that's an okay place to start, but it can be very difficult to value a laundromat.
Heck, sometimes it's difficult to figure out what their net operating income is.
For sure. If they don't have good books, and usually they don't. And a lot of times they have no experience. So a lot of times they think it's worth $1 million. But when you ask them where they got that number from, they'll tell you they pulled it out of thin air, right? They don't actually, well, that's how much I need to buy an RV and go live on the beach and whatever, and there's no reality. So a lot of times we have to know and understand, and then we have to teach them. Well, the reason I bring that up and the reason that's such a big deal is if we laundromat owners don't know how to value our businesses when it comes to acquisition and purchasing and even selling them, well, then why would the world of lending know how to do that well? Right? And we talked about the Eastern Fundings in the world and some of the other companies that are pretty good at that. But as a general rule, the lending world, doesn't know how to properly value a business, let alone specifically a laundromat industry or business, which is very unique. And the thing that makes that really tricky is something, Carla, that I pound all the time into people's head, and that is that most of us are building businesses that revolve around us. Without Dave, the business doesn't exist. And that's almost impossible to sell, right? We did a whole podcast on this with Mike. Mike Fingers, I think was his name, if I remember right. So go check out that episode, but he specializes in this field. And basically what he says is about 70 to 80% of small businesses can't function for more than a week, if I remember his numbers right.
Yeah. They might be profitable, but that doesn't mean they're sellable.
Right. They're not sellable businesses. And we went down this whole rabbit hole. Well, why do I bring all this up without going back into that episode? The reason I bring all this up is if my business revolves around me and my business can't survive for a week without me, the founder, then it really isn't a business, it's a job. And it's only a job for me because I happen to be uniquely qualified to do this job every day. Could I teach you, Sally, how to do that job? Yeah, but it might take me 4 years, right? And you're going to have to pay me for my time for 4 years if you expect me to do that. And a lot of small business owners don't know that. And so when I tell people, hey, don't, the whole Michael Gerber thing of working on your business, not in your business, I always say, even if you want to work in your business and you love it every day, try to build a business around the concept of the business not requiring you, not needing you, because that's the best exit. Right? So the reason I bring all this up, to bring it full circle, is most of us, when we're purchasing let's say hypothetically, a turnkey laundromat, we are purchasing a job from this person that we are not qualified to do. And the truth is that should be valued very differently from a risk tolerance perspective and all of that than it should be in just a perspective of buying a business that anyone can plug into. And so the reason that all matters, coming back to seller financing, is sometimes the only way to sell this business and to finance this business is by the founder financing it with seller financing. But the truth is, and we talk about this in the podcast with Mike, the truth is a lot of times they don't know that. They're not aware of that. They have to learn that through the school of hard knocks. They have to find 3, 4, 5, 6 people willing to pay $500,000 for their business. Then they go out and they try to get financing and they realize nobody will finance this business because without Dave Menz, that business is only worth $100,000. It's not worth $500,000. And so the only way to make this transaction happen between these two individuals that both want to sell and buy for $500,000 is by the founder being debt-free typically and being willing to finance it. And so a lot of times they aren't motivated in the beginning when it comes to being willing to finance this business. But once they go through that process, which takes a few years of kind of grief and all this, then they learn that if they ever want to sell the business, then they have to finance it. Otherwise, they just got to shut it down, sell the equipment for pennies on the dollar, and they're probably not going to get $100,000 out of it.
Well, just take a lot lower offer. Because if the bank's only valuing it $100,000, there's no way that they're going to get $500K without
even if you think it's worth
seller
$500,000.
financing.
And the only exception is if you have $500,000 in cash and you just write them a check. And usually those two things just don't come together. So, Cody Sanchez talks about this a lot on her podcast and her channels, and it's very, very true in the laundromat industry. But she talks about it in the concept of small business all together is that there are, I think her numbers are like 60, 70% of small businesses over the next 10 to 15 years are owned by boomers who don't have a sellable business. They own a job. And they're eventually going to figure that out over the course of 2 or 3 years. When they try to retire, they try to sell it, they won't be able to, and they'll eventually just shut it down. All the trades, plumbing companies, electric companies, they'll sell the assets for pennies on the dollar when somebody could have come in and done a seller financing type of deal if both sides were willing to do it. So I want to share a couple examples of a couple things we did that are a little bit different because both of ours are commercial properties. But in 2015, we bought our Anderson building, our Anderson store, which was our third store. We bought the business. We talked to the owner, which was a separate person, about a new lease. And the person happened to have inherited the building, so it was paid for from their dad. And long story short, they ended up selling us the building for $5,000 down on a 20-year fixed rate mortgage. And all we had to do is put $5,000 down, and we own this commercial property. They sold it to us for the auditor's value, which if you know anything about that, the auditor's value for tax purposes is usually at least 10 or 15% below what the actual appraised value of a building would be. And they inherited the building. They just didn't want to be they didn't know anything about business. They didn't know anything about commercial property. They knew I was the only person that would really want to buy this building because I own the business now. And instead of signing me to a lease, they just said, well, what if we finance it? And why did they do that? Well, when I first approached them, they said, well, would you be interested in financing or buying the building? And I said, yeah, I absolutely would. But here's the problem. I've bought and retooled 3 laundromats in the last 4 years. And every penny that I have is going into this purchase because I just bought the business. And remember the $300,000 I told you about to retool the store? We had put all our cash into it, plus borrowed another $300,000. So I just very transparently tell them, look, I'd love to buy your building and I'd be willing to pay what you're asking for it. But the truth is I can't get a loan for it and I can't afford the 20, 30, 40% down payment on it. And they were like, oh, well, what if we carried the mortgage for you? And so I was like, well, heck yeah. So that was a game changer for them.
That was his introduction into seller financing.
It was. I had never heard of it before then. This is a decade ago now. And I coach people all the time in some of the strategy, and I talk about it in my book. And I'm telling you, it's one of the most powerful things in the world. Another example I'll share with you just as recently as 3 or 4 years ago in 2021. A very different person, but we bought a commercial property with 2 acres, our new superstore we talk about all the time. It was very similar. We had a lot of cash, but we were putting all of our cash into the business and we were taking over the business. And the property owner came to us and said, do you want to buy the building? And I said, well, I do, but I'm not in a position to buy the building and put 20, 30, 40% down and buy the business and retool the business. And so they did something very similar. It's not the same person, but we did $5,000 down. We did a 30-year fixed rate mortgage at 5% fixed rate for 30 years on a commercial property. If you know how commercial lending works, you know how screaming of a deal that is. They also agreed to, because I asked for, negotiated the first 5 years interest only. So the first 5 years are interest only, then we pay the principal back over the next 25 years. If you know anything about commercial property, you know that typically commercial mortgages are usually only done over 20, 25 years at the most. So once again, we negotiated a screaming deal. Why did we do that? Because both sides won. Right. And
and that second one, the one most recently, that was an example of where the bank was valuing his property much lower than what we valued it at.
That's right.
He wanted this amount for it. The bank was valuing here. We were willing to pay here. And it took a little while for him to realize that what he was wanting out of it was never going to happen. What someone could get a loan for was way below what he wanted. And it was below what we were even willing to pay. So he realized through seller financing that he could make that deal happen. It was an example of that.
And it ended up being a fantastic deal for us. And to give you an example, the building 3 years later after our project and everything has been appraised at almost double what we paid for it. A big part of how we made this deal happen is we're probably the only people on planet Earth that could have made that deal happen. Why? Because we've been leasing another property from him for 10 years. And when we took over that property, it was in shambles. And we invested $500,000 in that property, made that property much more valuable, made the asset more valuable, increased his rent in his other spaces. He loves us. And for 10 years, he's got to sit back and watch us run laundromats. And so he trusts us, right? But we've built that trust, right? So can just anybody walk into any situation and make some of these deals happen? No. But if you position yourself correctly, you pay your bills and you do what you're supposed to do, a lot of times these seller financing deals will, quote unquote, kind of fall in your lap. And then it's just a matter of, okay, we both know each other, we both have trust. And sometimes it's not always as simple as you leased from that individual, but maybe you leased from their uncle or you leased from a friend or a neighbor, right? And you have a reputation in the business world, or you network through the Chamber of Commerce and you've had lunch a dozen times and they know who you are, and et cetera, et cetera. So all of these are parts of strategy. They're all important. But the thing I want to stress is you obviously with seller financing, you have to have two motivated people on both sides of the equation. And the good news about that is the whole world is available to us. If he wanted to write me a 75-year mortgage for 1%, he could have. And if he wanted to write me, that would have been nice. If he wanted to do something extreme on the other end of the situation, he could have done that too. And all it is a legal binding contract with collateral, and he can repossess the building, or his daughter, can repossess the building if we don't make our mortgage payments, and we can always refinance. But I just wanted to point out to you that there are some very creative ways. And maybe instead of seller financing, I should have just called this a creative financing, because the truth is, if you have two parties that are willing to do it, there's no one else going to stop you. In the banking world, in the lending world, in the SBA world, those are just employees and they have to follow the guidelines. But if I own an asset and it's paid off and I can collateralize that asset and I believe in you and I'm betting on you, then I can write a loan that I'm comfortable with. So basically, to tie a nice little bow around this for you guys, just kind of recap real quick. We have the seller financing, we have the equipment loans, we have conventional loans, we have the SBA loans. There are other types of lending out there, but they're more niche and specific in those ways. But hopefully this conversation today has kind of maybe spurred some additional thought for you. One last thing I will point out to you, because I try to talk about this with a lot of coaching clients. There's a lot of people out there in the industry that have borrowed money, sometimes multiple different loans. Their cash flow isn't great, but they only have 2, 3, 4 years left on maybe a handful of different loans, maybe 1, 2, 1, 3, 1, 4-year loan. One of the strategies we've done, regardless of these 4 categories, is just refinancing them into one loan. And instead of having a 2, a 3, a 4, and a 5-year loan, just refinance them all into a 6-year loan and consolidate them together. If you increase the terms, if you improve the terms, whether it's the interest rate or the amount of time you pay back, a lot of times you'll drastically improve your cash flow. So that's something to think about too, regardless of the type of loan you're getting, is if you find yourself in a cash flow situation, sometimes just doing a consolidation loan can improve your cash flow. Now, you also got to look at, what am I doing? Am I refinancing a loan from 2 years to 6 years? Okay, well, maybe you just want to pay it off in 2 and get it off the books completely. And that's for you to determine. But that's a strategy we used a couple times early on that got us out of some sticky situations where we had grown real fast, bought several businesses really fast. We knew they were going to do well. We just had to buy a couple years of runway. But ultimately, just as a reminder, the debt, remember, it's a tool. Some people refer to it as a weapon, right? It can be a weapon for building wealth. It can be a weapon for tearing down wealth and causing catastrophe, depending on how you look at it, the type of loans you have. So it can be dangerous, but it also can be insanely valuable. And the reason we want to do this episode is just to share some of these real world things with you, but to also point out to you that, like, for the people out in the world today that are just anti-debt, I'll leave you with this. We got into this industry in 2010 with a net worth of less than $50,000. And our net worth as of the recording of this is over $3 million. And it's 100% through the laundromat industry, right? The commercial properties, the businesses that we've built. It's not doing anything else. And so we're very grateful to the industry, and some of these types of loans and some of these types of strategies we've had to use that maybe weren't ideal at the time, but it was a means to an end to get us to our goal of creating wealth for our family. And we're going to continue to do this in the future. As I always share with you guys, we're in our mid-40s at this point. So hopefully, God willing, we have a lot of years left, and we'll be able to do a lot of more good for our community and for our family. Anything else we want to add before we close today?
I think that's it.
Yeah? Okay.
So once again, thank you for joining us for this episode of the Laundromat Millionaire Show, sponsored by HM Company, draintroths.com, and we will see you next time. Have a great one.
All right. Take care, everyone.
Is also wanting to, I'm thinking of distributors, so just nix that. So
Okay.
Anyway, so a great mentor along the way. So in that, what's the word I'm looking for?
Situation.
What's not the word I'm looking for, but that'll work. They can be really helpful in that situation.